Nos complace mucho desde nuestro máster, de nuestro Master in Business Analytics, tener la posibilidad hoy de haber organizado y promovido esta charla. Este es un paso más en tratar de ejemplificar el gran nivel que nuestro programa posee y que lo hace único en Latinoamérica. Este es sin duda un gran paso en el camino a seguir, continuamente mejorando y de esta forma mantenernos siempre en la frontera. Por supuesto, queremos agradecer muchísimo y vamos a dar más detalle de esto a nuestro invitado especial de hoy día, el profesor Robert Merton. Y también quiero agradecer mucho a nuestro rector que se encuentra hoy día con nosotros, Harald Beyer, y que en un segundo va a seguir en estas palabras de bienvenida a toda esta audiencia. Por favor, Harald. Está mudo.
A propósito de la tecnología, ¿no? Buenos días, bienvenidas y bienvenidos. Para nosotros, como Universidad Adolfo Ibáñez y para la Escuela de Negocios, es un honor contar con nuestro distinguido invitado de hoy, el profesor Robert C. Merton. Nuestros más sinceros agradecimientos para él por darse el tiempo para compartir sus ideas sobre un tópico tan importante para el mundo, en particular para las economías emergentes como la nuestra. Sin desarrollo financiero es imposible asegurar el progreso económico. A veces se olvida y por ello la charla del profesor Robert Merton es muy oportuna. Aprovecho también la oportunidad de agradecer al profesor Alexis Montecinos, director de nuestro innovador Master of Business Analytics, sin el cual habría sido imposible tener esta charla. Estos agradecimientos los quiero extender al máster, pero también a toda la Escuela de Negocios, por su compromiso con entregar una educación de pregrado y posgrado y una investigación que no solo es de mucha calidad, sino también se caracteriza por una innovación continua. En los últimos 50 años, las finanzas han tenido un desarrollo extraordinario. Este difícilmente habría sido posible sin nuestro invitado de hoy. Se dice que alguna vez Paul Samuelson sostuvo que la influencia de Robert Merton en las finanzas se puede comparar con la que tuvo Isaac Newton en la física. No estoy seguro que Samuelson haya dicho esto, pero si lo hizo, no estaba equivocado. Basta recorrer muy rápidamente su obra para darse cuenta de su contribución. Desde luego, esta quizás la más preciada de sus contribuciones, su modelo de precio de opciones. Su Theory of Rational Option Pricing es un artículo fundamental y además maravillosamente presentado. Algunos, debo reconocer, sufrimos hace ya muchos años con su lectura, pero entenderlo fue un momento de enorme satisfacción. Pero no pueden dejarse de mencionar otros aportes. El KPM intertemporal, por ejemplo, su enorme papel en lo que hoy día conocemos como ingeniería financiera, sus modelos de intermediación financiera, su análisis de por qué las instituciones difieren entre países y cómo cambian en el tiempo, enfoque que Merton llamó perspectiva funcional, quizás, como especula su colega Sui Body, un homenaje a su padre, el destacado sociólogo Robert K. Merton. No paran aquí sus contribuciones. El análisis del riesgo sistémico se vio profundizado después de la crisis financiera de 2008-2009 por el interés en entender este proceso por parte del profesor Merton. También, ¿no es cierto?, en lo que hoy día conocemos como reforma a los sistemas de pensiones, que finalmente es un desafío financiero de proporciones en todo el mundo y que se ha visto iluminada por las ideas del profesor Merton. En este campo se revela, quizás más que en otros, el marcado interés que él ha tenido por llevar sus desarrollos teóricos a la resolución de problemas financieros complejos, pero pensando en el impacto que estos tienen sobre las personas. No siempre esta mirada está presente en los académicos, y por ello estamos frente a un académico que no solo es grande, sino que extraordinario. Nuestra Escuela de Negocios tiene una reconocida competencia en el área de finanzas. Hay una investigación interesante y dinámica en este campo. En este sentido, el profesor Merton puede sentirse en su casa, aunque sea a la distancia. Muchas gracias, profesor Merton, por aceptar nuestra invitación y por estar aquí con nosotros.
Muchas gracias, Jara. Antes de introducir en inglés al profesor Merton y poder dar el inicio de esta presentación, les voy a dar unas breves instrucciones. Si se dan cuenta, en la parte de abajo del panel de Zoom tienen el Q&A, de modo que ahí pueden ir escribiendo las preguntas que les vayan apareciendo durante la presentación. Tomaré algunas de ellas después, dado el tiempo que tiene el profesor, y se las haré saber al final de su presentación. Y la parte más importante es que, si ustedes se dan cuenta, hay un globito como un mundo que es la interpretación. Si ustedes le dan clic ahí, pueden elegir el canal de español, en el cual va a ser posible para ustedes tener la traducción simultánea de lo que el profesor va presentando en inglés. ¿Ok? Entonces, para todos los que se sientan quizás más cómodos con eso, pueden aquí en la parte inferior derecha tener el mundo, le dan clic y pueden elegir el canal español. Muchas gracias. Okay, so let me switch to English. So good morning, everyone. Let me introduce Professor Robert Merton. I will try to be concise, although this is a difficult task when we are talking about an academic such as him. Professor Merton is a School of Management Distinguished Professor of Finance at the MIT Sloan School of Management at MIT, and a University Professor Emeritus at Harvard University since 2010. Merton received the Alfred Nobel Memorial Prize in Economic Sciences in 1997 for a new method of determining the value of derivatives. He is past president of the American Finance Association, a member of the National Academy of Sciences, and a fellow of the American Academy of Arts and Sciences. This year, he was named the recipient of MIT's 2021-2022 James R. Killian Jr. Faculty Achievement Award, the highest honor the Institute faculty can confer upon one of its members. The Killian Award citation hails Merton as one of the founding architects of modern finance theory, whose work has become an integral part of the global financial system. He is also a resident scientist at Dimensional Fund Advisors Incorporated. Merton received a Bachelor of Science in Engineering Mathematics from Columbia University, a Master of Science in Applied Mathematics from California Institute of Technology, and a PhD in Economics from the Massachusetts Institute of Technology, together with numerous honorary degrees from US and foreign universities. I had the opportunity to work with Bob in 2 courses as his teaching assistant at MIT, and he was part of my dissertation committee. These were by far the greatest professional experiences I have had in my life. I learned many new things in finance from one of the fathers of modern finance, but overall, I learned one of the most important lessons in my academic career: how it is possible to teach with passion and humility to our students. Before starting, I would like to thank you on behalf of Universidad Adolfo Ibáñez, its authorities, its faculty, and especially its students. Finally, and on a personal note, I would like to thank you for accepting my invitation to give this talk, despite the fact that you have an extremely tight schedule. This is, for all of us, a one-of-a-kind opportunity to learn from you. So please, Bob, you can start now.
Wow. Well, thank you very much for this wonderful introduction and for your warm welcome. I am delighted to be here with you all. In thinking about the topic for today, I understand that you all have taken a course in finance, have been exposed to finance science, and that some of you may be considering a profession or career in finance. And for others, just interested in knowing more about finance. So as I've selected today, I want to look at how finance, financial innovation, and finance science has impacted the broader economy, economic growth and development. To help locate for you where this profession of ours integrates with the broader society. And I'm going to do so going back in history, about a half century. So we have a long way to go in time, but we'll get through it, to today, and then a peek into how finance can do things for society going in the future. And I'm going to bring this to you through a series of examples over this period to illustrate the impact that finance can have on society. I have another agenda, which is, I hope perhaps some of you will be inspired enough to consider that finance is actually a very interesting and valuable field of endeavor. So with that, I'd like to get started. I'm going to bring up some slides to share with you. Okay, let me just move these to here. I'll move you over. Okay, so I said, oops, I need to click, oops, yeah. Okay, well, let me just begin first by pointing out something that's often forgotten, which is how important the financial system is to economic growth and development. A well-functioning financial system is essential. My former professor and colleague at MIT, Robert Solow, who won the '87 Nobel Prize for his work in growth theory, documented both theoretically and then empirically that growth is driven really by technological progress, not the traditional high savings rates or growth in populations, which of course do affect growth as well. But his contribution was to show how important technological progress is to growth. Now, all the wonderful technology that we've seen, both and most recently, sadly, with COVID, but the developments in science of biotech and so forth, the innovations there, which have developed vaccines and so forth, and all the technology we see out beyond this that we see are discovered in the labs and in universities such as yours and MIT and around the world. All that technology is not going to impact growth unless that technology can be delivered into the economy broadly and deeply. And finance plays an essential role in that process by facilitating corporations and creations and ventures and so forth, and financing them, and very importantly, distributing the risk in an effective and efficient way so that we can actually take this technology and bring it into the mainstream of economics and therefore impact growth. So when if you've been taught somewhere in class something about dichotomy, there's the real sector and the financial sector, Main Street and Wall Street, those are jargon terms, but they're not reality. The financial system is an inexorable part, an integral part of the economic system, and they can't be really untangled. Now, my agenda this morning is start to say, well, say a little bit by finance as a science. I think if you're in the field, you might want to know about that. And then I want to talk about how, that science and practice have become so carefully, inexorably connected. Even within economics, while economics is, of course, a very practical background, finance stands out within economics as the field where the most advanced research, both theories and modeling, but also data and empirical analysis, those most advanced science find their way into the mainstream of finance practice very rapidly. And that is really unusual that the actual models and data are used in finance practice. And I want you to see how that kind of evolved in history. The other I want to mention is to frame things, this is the role of financial crisis. The financial system is very important to the economy. So when the financial system has failure, it has very strong and negative impacts on the economy. And so among other things, I want to underscore from what I'm talking about today that finance is a very powerful tool, but it's a tool that needs to be managed by those who understand it. We need highly trained people to be in charge or to be overseeing the financial system. It's too important not to have that. So I hope that some of you who go in that direction will serve in that role in the years to come. Now, in the crises of 2008-9, the great financial crisis, and then subsequently in Europe, we saw financial innovation come basically to a stop, and even in some cases attempts to reverse it. But I wanted you to understand that that's not always what happens with crises. So I'm going to take you through a different period of crisis to show you that in fact crisis can stimulate innovation. Now I'm focusing on innovation both because it's important, but it's also topical. I'm sure you're all aware of the enormous innovations going on in finance now as a result of AI, the computer technologies, digitization of everything. And that's going to transform almost every economy in the world in terms of how they do financial services. And I'm happy because to believe that, in fact, the impact will be disproportionately greater in benefit to those who are currently being underserved. So we're in the middle of a major innovation. So perhaps it will be useful to go back and look in time. Okay, so first let me say a few words about finance as a science. Prior to about the 1950s, finance really was just a collection of anecdotes, rules of thumb, accounting identities, no systematic data of any sort. So certainly couldn't be called a science. I don't know what we call it, but there. But finance did become a science. And I would mark as the beginning of that process is Harry Markowitz's work on portfolio theory and developing the concept formally of diversification in his 1952 paper. So I marked this. Now, Harry is not, in my view, the father of modern finance, but he was certainly, in my view, there at the beginning and has had an enormous influence on finance. I'm not going to go through each I've put on this list. By the way, with my slides, you'll see they're rather dense. If I didn't give you permission, I encourage you to share the slides with any students or anyone who would, after the talk, would like to review things. So you have my permission to do so. But I would point out a few elements along the way. You'll recognize many of the professors on there, researchers who contributed. But I would point out one, let's say in 1960, 63, was the first comprehensive collection of data. Prior to that time, there was almost no financial data. I know it'd be hard for you to believe today. There was nothing systematically put together. Maybe the Dow Jones Index was about all that was available. And this went back and looked at and collected data on every stock traded in the US markets from the 1920s. And this was transformational. First, it gave us information and insights that we didn't know existed. But secondly, by creating a systematic and comprehensive database, you had the element that fundamental element you need to turn a field into a science, which is the ability to take on hypotheses, test them, as well as to have insights as to how the world works. And running all the way through, I'm not going to go through these. By the end of the 1960s, finance was established as science. It had a series of very well-defined theories, data, and they were being tested, and so it became, let's just say by the 1960s, it became a science. It parallels, by the way, the development of biotech. Watson and Crick developed their DNA model in about 1950, and that their work, of course, transformed how we do medicine and drug discovery and our understanding of health and human body, how it works. And from that came a systematic biotech science that didn't exist before, which of course is so fundamental to us today. So there are at least a time parallel. Well, let me move on and get to my first, as I mentioned, I'm going to take you through history. And I'm going to take you back to the 1970s, a long time ago, half a century. I have to confess to you, I was a grown-up then, and I was involved in these. So, this is a young science in that Harry Markowitz, who I marked at the beginning, is still working. So when the beginning of the science person is still working, you know it's a young science. But what I wanted to go through here is to take you through a crisis in financial markets in the 1970s that occurred. And let me just list the shocks that hit first to the US, but then around the world. We had currencies for almost a generation, since the 1940s, so 30 years, currencies were essentially fixed, the Bretton Woods. And suddenly, almost overnight, they were let to float and go. And so we had this huge shock of the new risk to the system affecting trade and everything else, which was floating currencies and dealing with currency risk. We had the first oil crisis. We didn't know, we had to start numbering them. We had two during the 1970s where oil went from about $2.50 a barrel to about $13 or $14, with the incredible shocks of that and transformation of how we use energy. And hard to believe today, although there's some worries a little bit now, we had double-digit inflation in the United States, really the highest since the 1920s, so more than a half century before anything like that had been seen. Really, no one was around who had that firsthand experience. And with that double-digit inflation, we also got double-digit interest rates. Can you believe it, that it was in the middle of the 70s, long-term, not just short-term interest rates were well over 10% and peaked in the early 80s and late 70s at 21%, I believe, was near the peak interest rates, US interest rates. Never been seen before by those who were around. We had regulations that wouldn't allow banks to pay more than 5%. So it doesn't take rocket science to figure out that if the government is paying you full faith and credit and tax advantage 10% or more, that you're not going to put a lot of money in banks at 5%. So there was no money for housing. Had nothing to, there's just nothing, no matter how good a credit you were, housing completely shut down. But then we had what the economists didn't really think at the time could happen, which is, together with this extraordinarily high inflation, we also had high unemployment. So the standard remedies, including the ones that we've seen during the more recent crises by governments around the world, trying to deal with high unemployment, when you have double-digit inflation, treating one in the traditional way is like putting gasoline on the fire of the other. This process of high unemployment and high inflation, called stagflation, as far as I know, we really don't know how to deal with that, or we haven't really resolved it. We have theories about it. And let's just hope it doesn't come back. In this period, the stock market fell by 50% in the US in an 18-month period. And really, we had a rather extensive recession. The purpose of going through all these is, if you hear the melody, if not the lyrics, is there was an enormous set of shocks that we had not had to deal with within modern times at that time. They all hit the system at one time. Now, let me show you what the reaction of that was in terms of innovation. That instead of cutting back on innovation and tightening up and being, making things more careful, there was an explosion of innovation to address these risks and develop markets and means and institutional designs to handle all of these new shocks and systems. So I just list them here. There was an options exchange, first listed option exchange. Options, as you know, are nothing more than insurance. They're financial insurance. So we developed a financial insurance market to insure values and protect risks. Futures markets were created for currencies, interest rates, and stocks to hedge those risks. The first electronic stock exchange. The money market funds were generated by the Reg Q blockage of banks paying higher interest rates. And we had a variety of fixed income innovations. Index funds, you all know that a big form of investing around the world is for individuals and for institutions is so-called index funds. And that they came into being at this time. International diversification in stocks, which is routine today, almost everywhere, it's ordinary advice, diversify. around the world actually had not been done really at all. And a big insurance company, TIAA-CREF, was the first to really institutionalize that in this period. The US developed its modern financial pension system, which included all the pension funds with trillions of dollars and so forth in this period, and created the so-called DC plans or 401ks or whatever you want to call them today, that are an integral part of so many retirement systems. In May of that year, we got rid of the cartel on the prohibited negotiated commissions on trading of stocks. And as a result of that, that began the institutionalization of the stock market, which is the way it works today. Almost all the trading, and certainly direct trading in stocks and so forth and other instruments of the world, are done by institutions, not individuals directly. And the institutionalization was triggered and facilitated as a result of that. Now, debt securitization and the creation of a national mortgage market. I mentioned a moment ago that there was no money for housing. It completely shut down. There was nothing. As a consequence of that, the way in which residential housing was financed in the United States was changed from local banks, each lending to local community, to having mortgages trade in huge pools and huge markets where anybody in the world could invest in those mortgages, and did, and created a global foundation for the capital for funding residential housing. And that national mortgage market, created over 4 decades ago, continues through to today. And never in the US since have we had anything like the shutdown in financing for housing. Yes, sometimes tighter, sometimes prices up and down. But this innovation not only addressed the crisis at the time, but has continued to pay social dividends of enormous value when you accumulate them for, in this case, residential housing. And we did very other things. And we also set the foundation for what we know, which is that even with some political changes here and there, that the financial system is global. People invest around the world through the markets, and it really is a largely integrated system, which of course permits the maximum amount of global diversification and risk sharing. Now, finance science played an integral role in this, and it was very fortunate, coincidental, that the science had been developed and was developing very rapidly exactly at the time when the crisis broke. And so the two came together, and we had a synergy of the sense that the science provided the mathematical models and databases without which you could not have created all these innovations in markets that I've listed for you. But at the same time, the needs in practice and to address all these things stimulated and influenced the development of the science. So you had a virtuous feedback loop between finance science and finance practice. And that partnership or integration has continued to this very day. And this is where it all really got started. And so this is how the two connect. And with that, I'd like to then move forward to, we got a ways to go in terms of decades, but we'll get there. I'm going to move on to a few more examples to illustrate to you the power of finance, and that finance really is able to solve real sector problems that matter to people and matter to the economy. So let me give you some of these samples. I'll take this one from the early 1880s. I mentioned in the US, about the interest rates in the 1970s being so high and volatile. So it was completely understandable why borrowers, whether they're individuals getting a mortgage for their house, or whether they're businesses, real estate development, raising money, that with interest rates not only high, but highly volatile, that a movement of 200, 300, 400 basis points in interest rates could actually put projects completely into bankruptcy. So the interest rate risk was extremely high for everyone. So it's very natural that those entities would like to get rid of that interest rate risk. So they had a preference for fixed borrowing. So mortgages were 30 years fixed rates, business loans 5, 10 years, and some corporate bonds 25 years. So there was a preference on the loan side of banks for fixed rates and to get rid of this interest rate risk, but it had nothing to do with their businesses, but could bankrupt them if they went the wrong way. On the other hand, the bank's sources of funds were deposits. And deposits, as you know, are people depositors, and the other customers, main customers of the standard bank, want to be able to get their money at any time they want at full value. So of course, the rate paid on those deposits has to be floating rate. You can't fix the rate and also allow people to get out of par at the same time whenever they want. And so a good bank, not a speculating bank, a good bank doing its job faced the following problem. To meet both of its customers' needs, lending fixed and borrowing short-term imposed an enormous exposure to banks to interest rates. And as if you've studied any of this, you know that every time interest rates went up significantly, the banks actually, many of them you could almost say would be insolvent in the sense they really, were underwater. And the only reason we didn't have failures is forbearance by governments who sort of said, well, it'll work its way out, hoping. So in fact, the risk became in banks at that time, I would say for a well-run bank, there was more interest rate risk than there was credit risk and the other risks that banks should be taking in order to perform the services that banks perform. And so there's this enormous interest rate risk. And a simple, at least simple to understand innovation that addressed this forever, the interest rate swap, which I'll explain to you in a moment, is my first example of that. I'll then go from there to the 1990s from the United States, and then really the swaps are around the world, to Europe to an example, and then go into the future and give you an example from Asia of how finance can continue to perform this role of impacting real society. So let me explain how the solution works. The interest rates, the swap in general, which I just remind you, a swap contract is nothing more than says two parties agree to exchange returns on some specified assets, one for the other. It's just an exchange of returns based on some agreed upon notional or basis amount. And it's simply a contract for transferring risk. So let's take the case of a bank that's lending money to its customers fixed, and then paying floating and has this enormous interest rate risk. If it enters into a interest rate swap contract where it agrees to pay a fixed rate of interest and in return receives a floating rate. So you might say, we will pay, if it's a 10-year contract, we will pay 4% fixed rate and receive some floating rate, either generate the treasuries or funding rates or whatever, some floating rate in exchange and on some amount. Now, if the bank that has this natural risk in interest rate risk, its earnings are fixed, its fundings are floating, therefore it's exposed to the interest rates. If it now enters into the swap contract, look at what happens to its earnings. It's getting fixed to its borrowers, but then it pays fixed on the contract. So fixed minus fixed. It receives floating from the contract and it has to pay floating to its depositors. The net of that is that the interest rate risk is eliminated. And what the bank gets paid for is banking services. It charges its borrowers a higher rate of lending than it pays on the swap rate for fixed. And it pays its depositors a lower rate than it receives on the swap. That spread difference of those two become the compensation to the bank for its services. So by a simple contract a contract that traded anywhere in the world and doesn't transform anything else that the bank does. Everything is done the same otherwise. Allowed banks to have the choice to eliminate all their interest rate risk if they chose. So if they took interest rate risk, they did so by choice, not by no choice in order to meet their customers' needs. And this allowed a great reduction in risk in banking systems around the world. And to this day, that's still going on there. And I think the interest rate swaps in terms of amounts involved, notional amounts, is somewhere around 600 or 700 trillion US dollars in the world. It's an enormous market. Very simple contract to understand, but to actually have implemented it at very low cost, in huge size, always available, was a big challenge of implementation. But the concept of the contract is so very, very simple. The swap contract is one of the most, in my view, most beautiful contracts or ideas because it's so intuitive, so easy for almost anyone to understand what it does. And it's a way of moving risks around and just sharing risks without sharing capital, without doing any other kind of things and so forth. So the interest rate, this was an enormous benefit that transformed banking so that today you can't predict whether a bank is going to be hurt or benefit from interest rate moves because they can have any exposure they want, done simply and at low cost. So that's an innovation that has, again, continued to pay social dividends in terms of how banking systems can work and redistributing risk in a more efficient way. This is just a picture of, this is the volatility in banks from interest rates beforehand. And basically they have the option of essentially eliminating all of it simply by these low cost interest rate swaps. Okay, now I want to move to, if we're going to get to the end here, I'm watching the clock, that I'm going to move to another situation, the early 1990s in Europe. Germany, East and West Germany, were being reunified. And when they came back together, it became a dictum, a fundamental goal and principle for the united country to bring what was East Germany economically up closer to it, one would hope, on par with the economic circumstance of the West, which was much higher prior to that. And to do so, that meant that the eastern part of the united Germany would need to grow and have to expand and develop. So I'm going to give you a very particular case study from that time. And then I show you on this map, the city of Leipzig, which is of course still there today, which was part of East Germany. In order to expand and grow, it needed to increase its electrical power capacity. And generating electric power in Leipzig area was done using natural gas as the fuel. So the city of Leipzig said, we need to get more gas to our city and put out and ask for proposals. And two proposals came forward. I call them option 1 and option 2. Option 1 was spend $50 million. These numbers may sound small today. If you want to put another 0 on them or something, you'll get a better sense. But at the time, these were substantial numbers. Spend $50 million to build a short pipeline to the west and buy the gas from the west, from the North Sea and so forth. And that price, of course, would be an index off the US dollar, typically related to US dollar heating oil prices. But in any case, so buy your natural gas from the west, build a small pipeline. The alternative came from the east, from Russia, at which a consortium offered to provide a gas to Leipzig. Have to build a much bigger pipeline. It would cost $300 million to connect it to the gas grid, but offered Leipzig, the city, a fixed rate contract in Deutschmarks, because this, of course, was before the euro. And so what they said is, we will guarantee you that you can have gas for the next 15 years at a fixed price, no variation, say, X Deutschmarks per MCF of gas. So those are the two choices to the city managers is to solve their problem. Now, when you look at these two, they have certain advantages. Obviously, the Russian one has a big advantage that the prices of the gas and therefore the prices of generating the electricity for people and for use would remain stable for 15 years. And stable prices were not only a good thing in general, but recall that this is a population of real people who had been living in a command and control economy where prices didn't change and where, you know, they were used to, you know, stability in prices because everything was administered. And so, you know how much gas prices could move, certainly in that period in the 90s. And so, you know, the idea of having the residents of this city who had lived with stable costs and price for their electricity and gas, suddenly having their monthly payments fluctuate with market prices was a very, very a big challenge to accommodate. And of course, the Russian proposal did that. Now, the other disadvantage, of course, is one thing is it's high capital investment. A third one, which was recognized at the time and of course subsequently has been realized in not Leipzig, but in other cases, it also created a political risk for Leipzig to Russia. Because of course, if they were depending on Russia and sending the gas, if they turned off the gas lines or had the potential to do so, that's a risk in itself. So that's on this option. These are the good parts and then the not so good. On the West, you did not have this political risk, much lower capital investment, but you had to deal with the price of volatility. So these are city managers. Obviously, the people running the city after the putting together East and West were the same people running the city when it was East Germany. So the city managers have been managing in this command and control environment, really are very unsophisticated, didn't understand present value. You couldn't show them a complex thing to analyze. They wouldn't know what to do with it. They would and wouldn't do it. Now, you know, that neither of these were looking particularly appealing to them, and they were thinking about it. And a bank, and I can now say it was JP Morgan in the days when that was a AAA bank, JP Morgan got wind of this situation, and they had a group that did solutions, financial solutions to real world problems using finance science and financial markets. Essentially, they were financial engineers solving, trying to find better solutions using financial science and financial markets. So they asked themselves, they came up, and this is what they do for a living. And so what they said, they came up with a solution that they offered to the city. And I underscore, it's important to understand the realities of situations such as the sophistication and political issues, as well as just the economics and the finance of it. But they came up with an answer that's the following. Let me just give you their solution first, then I'll tell you how they did it. They went to the city managers and they said, here's the deal. Take option one, get your gas from the West, okay? So do that. But in addition, we will sell you a contract. The jargon term for it is a cap. We'll sell you a contract that says, for the next 15 years, buy your gas from the West, pay market prices. Anytime the market price you pay is greater than X Deutschmarks per MCF, the same number as Russia had in its contract. Anytime that happens, JP Morgan will make up the difference and pay it to you. In effect, then what they were saying to the city managers, if you do this combination of option one plus buy this contract from us, your cost for gas will be either the market price in the West or X Deutschmarks per MCF, whichever is smaller. Well, it doesn't take rocket science to figure out which would you rather do. Always pay X for MCF, or pay no more than X, but get less if the market price is lower. Obviously, the second one, if everything else is the same, could be dominant. You don't need to do any present value or sophisticated calculations. It had another advantage, again, one that's often forgotten by technical finance people, which is, had they done the Russian one and accepted it, and they agreed to pay X Deutschmarks per MCF, what happens if the price of natural gas fell in the next years, let's say to X over 2? So the free market price of the West is X over 2, and Leipzig's paying X to the Russians. How do you explain to the people in your community, in your city, why the city is paying twice as much for gas as you could buy it today in the market? Of course, we all know that's what happens when you hedge at a fixed price, that you get rid of the risk. But that means if it goes the other way, you wish you hadn't done it. Now, people can understand hedging and that risk. Try to explain that to a general population why you're paying twice as much for gas. Huge political risk and challenge. And that's very real. This got rid of that because you're always a winner. You either pay the same as with the other at less than the market price, or you pay the market price. So it got rid of both the political risk as well as the economic risk. And you could count on having those resources at that price for planning and for construction of new electrical plants. Now, the deal was that that's the deal. Then, of course, whenever you see something that looks too good to be true, you have to worry that it's probably not true. So how was JP Morgan able to do this, give an absolutely better deal than the Russians offered? Did the Russians highball them? No. Maybe it was a credit thing. Well, it turns out JP Morgan was a better credit than the Russians. So actually it was an upgrade in credit. So it wasn't that Leipzig was taking greater credit risk. So how is it possible JP Morgan is going to make money on this? The answer is that by going the JP Morgan route and taking option 1, you only have a capital investment of 50 million. Whereas if you do the Russian one, it's 300 million. That means it's $250 million by not doing option 2 that's on the table. And the terms were basically that JP Morgan got half, 125, and the city of Leipzig saved 125. And 125 was a profit because the complexity of doing this contract, which looks very simple to the customer, was extraordinary. JP Morgan was not only guaranteeing on the price of gas, natural gas, but it was also doing the Deutschmark because it was doing Deutschmark contract in a dollar market in gas, and it was doing an option because it was putting a cap on it. So therefore the volatility would impact as well. So both the foreign exchange and the gas markets risks were all being absorbed by JP Morgan. The hedgings were complicated, dynamic, and it was a 15-year contract they were writing where the markets were only, for laying them off, for only 5 years, maybe 10 in a few places. So they had to roll these contracts. So it was a very complicated thing. I won't be going on it. But that's JP Morgan's bad business. They are experts in this. They have capital and they have the expertise. Their job is to do the complex part, not to say to the city of Leipzig, we're going to advise you how to hedge and do something and you take all the risk. Well, they have no idea how to do that and they're the wrong ones. So this is an example of putting the risk in the right place, putting it with the people that do it for a living, not the customers, making it simple and understandable and transparent to the client, to the customer, and putting the rest onto the experts and the capital markets to handle and bear those risks. Today, it would be much easier to do this because there's so many more markets. But I remind you, there were only limited markets. There was no market for trading gas. So they had to take lots of basis risks they could use. They could do crude oil, they could do heating oil, basis swaps, things like that, some FX. But by and large, they had to synthetically try to hedge the exposure of the bank to its guarantee or to its contract that it issued. And of course, it had to cover that risk using its capital. So this is an example where Leipzig came out way ahead. It saved $125 million, which is a lot of money for that city at that time, or for anyone, but for them, and got a contract that politically, socially, and other ways were exactly what they wanted. It solved the very big, important real world problem. But I want to point out one other feature of this, which is very modern today, 2021. And that is, it was a green solution. And what do I mean by that? Well, we all know what a green solution is, dealing with the environment. And what this contract did was, instead of having a very big, dirty, all gas pipelines are dirty, we know that, but a very big one built all the way from Russia, okay? Forget about the cost of it in dollars. Just think of having this big, long pipeline from Russia. We had a much shorter one, smaller one instead. So a pipeline that was dirty, polluting, was not built. That's very green. So I wanted to point out that while green is big and important today, and as it should be, and certainly much more innovative, that finance was solving problems, including ones that made the world greener, just through contractual agreements. Nothing physical. JP Morgan did not build anything or anything. It simply moved, it structured the risks around in a fashion that were more efficient. And so that's the message here. This is the message throughout. Finance may not have tangible things, bricks and mortar or producing it, but by shifting the risks and so forth, you can see this had very real effects on the people of Leipzig. And of course, this was repeated. Second on that, and I move forward to this, is so that you see this isn't just an aberration. I switched back to the United States, where the Tennessee Valley Authority, which is at one point was about 20% of the electric power of the United States, was looking to, in the late 90s, in the middle 90s, to the 21st century, an expansion of it would have to do to deal with the increasing demands for energy. And someone came up with the suggestion of why not look at a way of using financial contracts, derivative contracts, to create a means of organizing the existing capacity in the grid system in a fashion that will produce more electricity where it's needed from the existing capacity, without having to do any actual construction or anything, but just by reorganizing all the different sources of supply to the grid. Things called mom and pops, very small suppliers of gas, electricity to the grid, and of course, very big ones. And so what they did is they sold puts on electricity, and they bought calls on electricity from only, not from financial people, only from entities that were actually physically connected to the grid and could deliver the electricity into the grid directly. And they put these out there. So basically they were selling forward guaranteed price, guaranteed demand for electricity to be delivered to the grid. And as a result of those contracts, enough of them were taken by all these little groups, all together around the world through this offering. They got enough extra capacity through this reorganization, not building anything new, just through this reorganization. So they did not have to build 2 nuclear power plants. As I mentioned here, that's like 35 conventional ones. And I bring this up as, again, an example where contracting solved a real world problem and had a really big physical impact. And of course, this is also a green outcome. It didn't have to build 2 nuclear power plants and still got the capacity. There is no way an organization or a policy or people could have organized all these different suppliers of electricity in this fashion, such as to get this kind of efficiency out. And so again, by creating a market and these contracts, reorganized the supply and demand and shifted the risks in a fashion that got more efficiency. And so this is a green solution as well. Okay. So that takes us through there. Now, that's the end of the history part of this. So let me stop here and then go, before I go forward to the future in the next 15 minutes or so. And that is to say, looking back on this, what I hope you saw was a variety of important real world problems, challenges, where innovation and the use of financial markets and financial contracting to solve problems. Problem solution, not a game, not moving the deck chairs around on the Titanic, not really having no effect. Big effects, big positive effects. And the interest rate swap, as I mentioned, as many of the other innovations, have been paying social distance everywhere in the world since. So the cumulative impact of that is enormous. And I mentioned, by the way, all the innovation done in the US back at the beginning of my remarks were done under pressure of need of the crisis. But afterwards, the rest of the world have developed most of those same markets voluntarily, not under pressure, which I think is pretty strong evidence that unless you think the rest of the world are masochists, that they see these innovations as very favorable ones that were improvements that they brought to their own country and system. So now we stop here for the moment, looking at the past and the range, and think about innovation in the future, where you're going to be when you finish your studies and then go on and build careers, whether they're in finance or not. And I wanted to use this slide to say something about financial innovation, which of course is the mechanism or the driver of how it makes financial systems better. And I go back, this chart's from the 12th century of various important innovations, bill of exchange, double entry bookkeeping, and so forth. But I want you to see the picture in seeing this timeline up to today. The distance in time between these major innovations to the point now where on this scale, you'd need a magnifying glass or maybe a microscope to see the time differences on how quickly important innovations have been going on. So the message from this slide is the following, that not only has financial innovation been going on for centuries, its rate of innovation has been accelerating. So what took 5 years, 10 years, or 30 years for an innovation to come to fruition in the past will only take a much smaller time frame than that. And it's critical to understand that the innovation speed of innovation is accelerating, and that has implications not only for those who are in the business or who are looking at competitors or thinking about corporate strategies, but for policymakers and for overseers and for government planners. That, you know, a typical practice in government and big corporations, when they do something big like a new retirement system or something, or they go out and collect best practice. And they collect all the best practice they can find, and then they kind of put it on a table and they look at it and they say, well, this one will take and this one will take. And you take a bunch of best practices and you come up with what you want to do to design the retirement system or whatever payment system for the next generation. What this picture is showing you is big mistake, because of course you look at best practice, but best practice is not good enough for that purpose. Best practice, because it's practice, is a legacy. It's the past. Now, when you're driving down a highway, I do this, don't tell anybody, sometimes pretty fast, and I look in the rearview mirror to see if anyone's going to interfere with my driving. I suddenly realize I'm driving on the highway at 30 meters a second, looking in the rearview mirror. Now, as long as what's in front of me is the same as what's behind me, that works. I can look in the mirror and drive perfectly. But if what's in front of me is a change from the past, that's a disaster. And that's my metaphor for you. If you look at this slide, you can see clearly the one thing that isn't true is that the past and the future, the past is a good forecast of the future in this respect. Things are going to change a great deal. So when you're going to make a major innovation, a major policy design, wherever you are operating, it's not good enough to look at best practice, what is being done, but rather to consider what could be done, not as an experiment, but there are many technologies, including in finance, that have not been applied in particular areas, but could be, and are market proven. And it's very important to always be looking forward, not backward, when you consider it. So I point this out on the topic of innovation. This is also great excitement. I've sometimes had my students say to me, you know, you've all this great transformation that took place over the last half century that, you know, I wish I had come at an earlier time, I could have gotten in on all of it. Well, my message to you is, and in this picture, that yes, a lot has happened in the last half century in finance to transform the way things are done to have an impact on society. But there's still much, much more to do. There's more in front of us than we've achieved before us. So if you're just starting today or next year, the opportunities, in my view, are extraordinary. And technology and advances in finance science, and of course need, are going to be the drivers of that. And so with that now, let me just show you a hypothetical, because it hasn't been done, a way to apply finance science to solve a problem in the areas of public policy. And the motivation for this is what happened in China in the latter part of 2015, in which, just to remind you if you don't know, well, the Chinese stock market went up a great deal in the beginning part of 2015. And then around the third quarter, you know, September, August, September, it just started crashing. And the response in China, the officials were not panicked, but very, very concerned about stability. And they wanted to, you know, to stabilize things. And in fact, stabilization became more important than, let's say, growth, having things stabilized. So they took a set of steps which were like capital controls. They shut down some markets. They wouldn't allow money to flow out of the country, et cetera, et cetera. You know, classic kind of capital controls as an attempt to stabilize and avoid having a major meltdown in their view. I'm not here to debate capital controls. That's not what this is about. But what we all know from capital controls is they have a cost. Now, the fact that they have a cost doesn't mean you don't do them, but they do have a cost. And the cost I want to identify for you using the fact that you've taken finance is that, and I take the extreme to make it clean. Imagine you put complete capital controls on China. They didn't do that. They didn't contemplate that, but suppose they had. That means all investment in China has to be done by Chinese internally, no foreign investment. And it means that investors, people in China, can only invest in China. They can't invest overseas. They can't. So they give up one of the cardinal benefits that you learned in finance, which is the benefits of diversification. And that if you hold a well-diversified portfolio, the best being the global portfolio around the world, that's the most we can diversify until we move to Mars or something, okay? Then you know from the study of the capital asset pricing model, that's going to give you the highest reward for the risk that you take, whether you're an individual or an economy. And so I've drawn here is risk measured by standard deviation, here expected return. And this red line represents the trade-off between risk and return you could have earned for the 20 odd years from 1993 to 2015. The period doesn't matter. You'll get different numbers. The same principle applies, but these are real data. This is the risk return off you would have gotten. So for taking a given amount of risk, this was the return realized. Whoops. And now, if you only invested in China during the same period, now remember, China is a big economy, was big then, huge growth economy in this period. This is the risk return you would have gotten, way lower. So for a 10% risk taken, you would have gotten a return here. Had you taken the same 10% risk in the world portfolio, you've gotten about 400, 500 basis points more, a huge amount of difference. That comparison is not the cost of specializing just in one country, in this case, China, because this is after the fact, as is this. So to measure, since decisions are made beforehand, before you know the outcome, obviously everybody would know what to do if they knew this is what was going to happen, is to ask yourself, how do you expect China would have behaved if China performed as expected? It neither outperformed or underperformed, okay? I do that by asking the question, I don't know what the expectations on conditional were for the world market, but I could ask the conditional expectation, conditional on what happened to the world market. What would you predict China would have done if it behaved as expected according to CAPM? That's the green line. So this is what you would have expected to get if China performed as expected. This is what you'd get if you use full world diversification. The difference for any risk level between the two is a measure of the cost of the ex ante cost of investing only in this one country instead of taking advantage of the global. So it's the difference between these two lines. So if we take 10%, this is what you would expect it to get, and this is what you would expect it to get if you took conditional on this is what you got it done the right thing. And that wedge difference is the cost. So this is properly done in terms of science. This is expectations, not ex post realizations. Conditional. Bottom line, this number for China is about 3% a year. So one could summarize by saying imposition of full capital controls may have many other implications, but one of them is to impose a much lower return for risk for the economy as a whole, or for China as a whole, roughly for this period, about 3% a year. 3%, just to put it in perspective, if you've learned, I don't know if you students still learn a rule of 72 anymore, how long it takes to double your money at an interest rate, but 3% doubles in 24 years. So giving up 3% means that if you don't give it up, your pension fund, in case of China, NCSSF, the National Pension Fund, would have twice as much resources in a short generation. I only do that to scale for you. This is a big problem. This is a big challenge. This is a big cost. How can you do the policy of capital controls? I'm not arguing you shouldn't. You want to do it. But somehow engineer and get rid of this unwanted 3% cost. Clearly, those who wanted the capital controls for stability didn't want to impose a 3% cost. That was just collateral damage, if you like, side effects like in a medicine that you don't want, but you have to suffer. How do we solve that? Well, that's what I wanted to show you next. That I wanted to show you that, once again, we use a very simple tool, the swap. So let's suppose capital controls are completely imposed in China. So all of China's shares have to be held by their institutions and individuals. So their sovereign wealth fund, their pension funds, the individuals all hold 100% China shares. No foreigner owns them. Okay, and they own no foreign shares in this full capital control. So the return to China is the return on the A shares, the concentrated risk. And we know, as I showed you, this is the line, therefore, of risk return that investment strategy provides. Now, suppose that they entered into, all these institutions entered into a total return swap where they paid the total return on China shares and they received the total return on the world portfolio. What would be the net economics to them? Well, they would earn the shares on China A shares. They would pay that return and receive the return on world. Net of these three, they would get the return on world, even though physically they own nothing but China shares. The voting control rights and everything else are all in Chinese institutions, if that matters. All cash investments made are going into Chinese companies, okay? All the politically and social issues that come up. And that allows us to have capital controls. But now, economically, by putting the swap in, we have allowed the economics to move from here to here. You've recovered that 3%. Notice we're only getting rid of the side effect. So we don't have to debate here whether capital controls would have been a good idea or not. Was it worth it? That's a big debate which goes on all the time. Well, I think we could have consensus. Which would you rather have? Capital controls with a 3% a year loss or capital controls with no loss? I think we could get consensus on that. So you see how this is a chance to really modify and make, not change policy, but implement policy in a much more efficient way with a very big move. Now, just to finish on this before I take questions, I'm sorry I'm running a little over, I apologize. But I want to finish this example because I want to get across to you that a solution isn't just a concept of a contract and some mathematical analysis and some simulations. You have to consider all the aspects, including implementation. How do you get this done? Suppose you came in to propose this to decision makers in China. The persons in the room you need to convince are the people who are feel the most important thing is stability. Stability is more important than growth. They'd be willing to give up 3% to get stability of capital controls. Let's hypothesize. If you can convince that person or those people that this is a good idea, then you got the room. So someone will say, well, wait a minute, with the swap, you do have some capital flows. So that violates only in its narrow technical sense, because first of all, the swap specifies exactly how much will be paid in the future. And it's pre-specified and fixed. Namely, the difference, what's paid on the swap by China depends on the difference between what world stocks earn and what Chinese stocks earns. Okay, you can see this is a contract. They pay the return on China, they receive the return on world. If world does better than China, they actually get money coming in, not going out. Only time they pay money out of China is when China outperforms the rest of the world. Those are good times for China. If China's outperforming the rest of the world, that's not crisis times. That's not states of the world where you have to be worried about a run of people taking money out of China, okay? So actually, this solution, in my view, and that would be the argument I would give had we been making that in China, this is more stabilizing than capital controls themselves. Why? Because when times are tough for China and the returns on the shares are lower than stocks, people are from the rest of the world have to contractually put money into China, not take it out, put it in. And in return, of course, when China outperforms the world, you pay out. So you pay out in good times when you don't need the controls, and you get extra money actually flowing in, which is more stabilizing than no money flowing in bad times. So that would be the gist of my argument, to say that actually this is a more stabilizing solution, as well as saving a substantial amount of economic cost in the form of lower returns per unit risk. It also has some issues about mitigating asset bubbles, et cetera, but let's not get into that. So what's the message from this hypothetical? This is all doable. Who would take the other sides of the swaps? Well, one of the beautiful parts of that is that everybody wants to hold a well-diversified portfolio, whether it's the Petroleum Fund of Norway, the Sovereign Wealth Fund of GIC in Singapore, et cetera. Everybody wants to hold some amount of the world portfolio. But if there are no China shares available because of capital controls in China, then there's a demand that's not being filled by all these outside of China institutions that can, for the risk. They don't want to vote Chinese stocks. They don't need to put their cash in there. They want the risk exposure of China. And that gives this to them. So there is a natural buyer for these swaps, even in enormous scale. And the counterparties are super high quality, credit quality institutions. The National Petroleum Fund of Norway is probably a better credit, or a sovereign wealth fund is probably better credit than many countries. And in any event, swaps don't have any principal risk, as you probably learned. So the credit risk inherently in swaps is very low. Bottom line, and then I'll quit on this, is to simply say, look at this. This solves a big problem, public policy on an enormous scale. The answer is completely feasible. I can tell you where to get this counterparties. The contracts can be done. I can deal with credit. And I can even give you the argument that it's more stabilizing. This is the kind of thing, whether it's JP Morgan in Leipzig, that's been going on and should continue to go on. And this is a great part of the value added, in addition to facilitating payments and so forth, which the financial system does. Innovative solutions, solving problems, having a big impact on economies, on big issues. Thank you very much for listening to me. And I hope that this encourages you to consider and go forward in what finance is all about. Thank you.
Thank you very much, Professor Merton. It was a very inspiring talk. Actually, it was very good to know how financial innovation can generate all these good things for our economy. So I'm gonna pick, what I'm going to do now is I'm going to pick some questions from the audience that they already wrote, and I'm gonna translate in some cases this to you, and in other cases, I'm going to take this directly from the English. So first question is, Ricardo, what are your thoughts on how blockchain and quantum computing enhancing of financial engineering might redefine the roles of central banks and commercial banks?
Very good question, a very big one. But let me just say this, that the technology of blockchain is going to have many, many applications. Whether it's applications to things like cryptocurrencies that are non-legal tender currencies is a different issue. But there's no question that the blockchain type technology has many important innovations, as was the digitization. So the combination of technology with finance science, technology by itself is only going to solve problems that are already existing, where you just replace what's being done now with a digitized version. Blockchain and other open the door to do innovations that couldn't have been done before, or to do them in a very different way, much better. So I'm quite excited. But I also say that, as we observed, whenever there was a big wave of innovation, there are a lot of things that come out that don't make sense. So the winners in the banking and in financial services it's not clear. For example, and I'll just mention this, while it could be true that traditional banks and so forth are become dinosaurs or disappear or become utilities or so forth, and that the new functions of those banks who are being served are done by, Alibaba, of tech firms or firms that we've never seen before. And there'll be some of that maybe. But recall that, traditional institutions, as they're called, they have a lot of things going for them. They have capital, they have reputation, they're highly regulated, but that regulation is a form of trust. And people need trust to do financial transactions. And they have the capability to buy technology. No one has a lock on technology. It's a competitive industry. So the biggest institutions today could choose to buy it. Now, the fact that they can buy it doesn't mean that they can transform their institutional design to use it properly. I don't mean technically, but in terms of their business model. And those ones will fail, or at least become trivial. Those are not the ones I have in mind. What I have in mind are the institutions that have trust, that have capital, that people recognize, that are regulated in a way that creates an important amount of trust with people to use them in important transactions and so forth, are those institutions that are able to restructure their business model and how they run themselves to work well with the new technology. That may only be 1 in 10, I don't know the numbers, but that could lead to a very different outcome. Now, I'm not giving you a prediction of which way it'll be, probably a mix of them, okay? But don't buy into this simple idea that the world is just going to be technology and people, and there are nothing in between, because that's an abstraction that is not a good one in the world. Technology by itself is not trusted. Yes, if you can verify it easily, as you can with some payment processes and things, sure, because if you have verification, you don't need trust. Similarly, if you can make it transparent, truly transparent, you don't need trust because you can see it. But most financial products of any sort, most financial services, things like investment advice, things like you entrusting your deposits or your savings, are inherently opaque, can't be made transparent, and are very hard to verify. Superior performance is very hard. All the models that are inside the technology, the content, not what you see on the screen, fancy, quick answers, simple things telling you to do things, but the substance, the models that drive those advice, who drive the things that you get from the coming out of the machine to you, okay, what you invest in or what you should do and so forth. The content is totally opaque and very hard to verify. Things like investment advice takes decades often to get a scientifically significant statistic. So my answer to you is, it's very exciting. It will have a great impact. It'll open doors to being able to do many better solutions in the future. Okay, all of that is good, and I'm enthusiastic about it. And that's another good reason to go there. But don't buy into the simple forecasts. We all like simple models, but if the model is too simple and you actually act on it, that may not be a wise thing. So, keep watching. But I'll tell you this, the finance science that you've learned in your classes doesn't change. Risk return, how you do these things, what you can do, what solutions are possible, what markets you can design, what it costs you to be able to do all of these things, they change a lot. But the principles, the foundations that you've learned in your class are rather robust. And as we develop new ones and better understanding of how finance works, implementing that finance science with the technology is the route to true innovation, solutions, and improvement. And I'm enough of an optimist to believe that while we may make mistakes and go along wrong paths for a while, by and large, the forces are such that we will end up going in the direction of greater efficiency and improvements simply through competition globally, and the accessibility to capital to develop these resources.
Thank you very much, Bob. So from Marcelo, another question. How do you think the COVID crisis is going to affect the way we implement these financial innovation?
How do I think the current financial crisis?
Yeah, the COVID crisis, yeah.
The COVID crisis. Well, that's very good. I would like to talk about that. In fact, it's rather, from a discussion point of view, of course, this was fundamentally a crisis of public health. This was not a financial crisis triggered in the financial system, but of course, a monumental public health one with huge economic impacts. And with some degree of luck, at least in the US and some of the other countries, less so in emerging markets and others. So it's been very uneven, and that's sadly so. The economic impact has been far less than it could have been. But there's no question, this is a huge crisis. But it's a very different kind of crisis than we had in 2008 or 2009, or that we had in the 1970s that I told you about. So don't make the mistake of saying all crises are the same, therefore the medicine to take for that or the policies to follow are the same. So COVID is different. We're still learning out of this. And we, of course, sadly, we are finding out that even though we've had the remarkable, and I underscore remarkable, good fortune to have efficacies of vaccines develop so rapidly, that at least holds hope for us to do it. But like so many things, and I've mentioned it in a different context of innovation, implementation, you can know the answer in theory. You say, I know how to solve this problem in theory, but actually implementing it is a bigger deal. And as we've seen with getting the vaccine where it needs to go, even here in the United States and elsewhere, but particularly here, where there is a vaccine available, people aren't taking it. And the implications of that are profound. So I don't want to, but in any way, reduce it. But I do think we need to recognize that this kind of crisis is different from, let's say, financial crisis or historical crisis. And we have to adapt solutions looking forward, as I said, not trying to look to the past and fit it into a situation which really doesn't match. You know, and if you've watched the performance of financial markets in the developed countries anyway, you know, nobody, I think, thought that what would happen did. Well, that's not true. I think some people did think that because it was a public health crisis, not a financial crisis, that markets would do better than they thought. But nobody, I think, could have predicted what actually happened with market share. It happened. So it's a very different story. And I wish I could give you a single pill that solves all crisis problems, but that's not reality. You know, remember this: what's worse than being uninsured? It's thinking you're insured when you're not, because then you don't even worry or take steps to deal with it that you would if you knew you were uninsured. And just so, if we act as if we think we have the solution to a crisis based on the past where that doesn't fit, that's worse than recognizing this is different. We have to bring to bear our knowledge of finance and economics and experience and data. And it's going to take time to work out the best solutions and to implement them.
Okay, thank you very much. Now from Andres, according to your view, what role did financial innovation play in the 2008 financial crisis?
Very good question. In fact, I alluded to it in my opening remarks, that the reaction when the crisis hit and thereafter, first the belief or the statements were that financial innovation was what caused it. First of all, there wasn't one thing that caused it, and I'm not going to get into all of that. And there's been a 10-year retrospective analysis done by the very people involved, Ben Bernanke and so forth, and others, of what caused it. But yes, these tools like the swap I just showed you on the screen are very powerful tools. They can transform and transfer risk very, very efficiently. They're very powerful tools. And if they're very powerful, that means that they can move, you know, huge amounts of risk around and do things. If they are misused, they can do considerable damage. There's no question that in two parts of the 2008 crisis, that during that there were innovations in certain parts of the mortgage market and some other finance that were ill-founded, to put it mildly. I would say if they weren't significant, they were silly. And it was an example of just bad practice. However, I think it's a consensus that it was not those things by themselves. It wasn't the subprime mortgages by themselves or something like that that caused the 2008 crisis, that it was much more complex, that the plumbing was where it was. It wasn't hedge funds or exotic instruments. It caused it. It was, you know, in things like the repo market and, you know, the absolute plumbing of the financial system where things broke down. And so, you know, innovation can be misused like any powerful tool. And that's another reason why we want to have both our overseers as well as our producers or users of the finance tools being well-trained in finance so that they can do a good job of understanding what's going on and monitoring it, and therefore helping to, you know, make sure that it, or try to mitigate chances for things coming off the rails, but not doing it in a crude way with a 30-second soundbite that says any innovation, you know, the argument at one point was there's been no good financial innovation. I won't tell you who said this, but you could look up the quote. You'll probably be able to find it on the internet. There hasn't been a real useful financial innovation, was said, for society since the ATM, you know, where you can get your money out of the machine. Now, of course, the ATM is not a financial innovation. It's a technical innovation, the one thing. But the ATM, I will remind you, was actually created in 1969. So if that statement were true, what I showed you on the screen this morning, all the innovations of the 1970s, all those markets, all those institutions, pensions, everything, all of those were not useful to society. The national mortgage market, the solutions of the swap market for interest rates. I just remind you. So don't, if you're going to become a professional, you have a higher standard you have to hold yourself to in your area. Don't go by sound bites or what someone says, and even in the New York Times or the Financial Times or other very highly credible places, okay? Those are not primary analyses. You actually analyze and look at the facts as best you can find them and use the tools that you have to analyze it. So, the answer is that have well-trained people, lots of them, we need them, and that, innovation on a whole has been very, very valuable to society. It would make a huge mistake to get rid of it. Innovation risk is always there, not just in finance. Nothing comes for free. Whenever you do something new or do something innovative, you take risks. But they have to be informed risks, and we have to be cognizant of them and manage them well. Risk management is critical, and that's what you learned a lot of and studied finance. And that's why we need that.
Thank you very much, Bob. And last question that I'm gonna pick from the pool. So what do you think are the pitfalls we have to take into account in financial innovation? And actually put it in a different way, what should the governments take into account when they decide to implement one of the policies you described in your presentation?
Well, great question, very important. Some of which I've already kind of alluded to in my remarks. The answers are that we need regulation, good regulation. Regulation establishes trust. Think of medicine for a second. How many people would take a pill or put the pills in their children's mouth where you have no idea yourself what's in that pill? You don't know the analysis or anything else. I think very few of us would be willing to do that if we didn't have regulations, the FDA in the United States or their equivalents and so forth, would certify and give us confidence and trust. Not that it's perfect, but that very competent people are doing competent things. Now, unfortunately, there's no safe harbor. We can have no risk of innovation if we don't allow any innovation. We can have no risk from taking drugs if we don't allow people to take drugs. But that's not a good optimal solution because there are benefits from financial innovation and from drugs. Therefore, we need intelligent, well-informed regulation. I know that may sound like apple pie, but that's the answer. The answer is you need to have people analyze these things well, just as they do in medicine. They have to do it in finance. We have to have a balance of regulation that allows innovation to happen, the benefits of it, but manages it in a fashion that avoids or at least controls the risks that we're taking. If you use the physical example of a train innovation where you can have a train that goes 300 kilometers an hour, you'd be crazy to let the train run at 300 kilometers an hour if the track that the train was running on is only valid, can only handle 150 kilometers an hour. That'd be very, very risky. And often the mismatch between the innovation, a successful one, and its infrastructure, the track, is mismatched to begin with. So you need to control the speed to some degree during the transition. On the other hand, if you permanently put a low speed limit on, you won't have the risk and you won't get the benefit of the high-speed train. So the answer to you is we have to have competent people looking at this in a scientific fashion, the same way we do in the science of medicine and other places of critical importance to us that are opaque and we have to trust. And the same thing is in spades with finance. Is that doable? Absolutely. How well we do it? There are many forces out there in the practical world that can derail it or at least do it. So I can't say much more than that other than I hope that some of you become professionals and contribute to this, that as professionals that you apply yourself to the science and to the facts and to the data with a willingness to say we don't know yet, or we only know this much. And but with a, not listening to the something that's said 100 times. If it's said many, many times, it must be true. There are plenty of examples from the 2008 crisis you asked about, of things that were said by people all the time that turned out to be factually incorrect. And so, that's the best I can tell you. And that's the challenge, but it's also the opportunity. And that's why there's real value to those who become engaged either in the innovations themselves or in institutions like central banks and so forth, who have to monitor and take responsibility for the safety and soundness of those innovations, implementations for society at large.
Thank you very much for today's talk, Bob. It was amazing as usual. I remember the time when I was in class with you, it was always the same kind of a show. So thank you very much. I would like to say some concluding remarks. Well, we would like to thank to the audience for being here today, for the great questions they have provided, and for the amazing attendance. I do not remember another talk where we had so much interest in the presenter and in the presentation. I would like to thank our president for his work. Thank you very much, Harold. I want to thank the people behind the scenes that organized the event and made this possible. Thanks so much to the interpreters that made the connection between our two languages. And finally, we would like to thank again to our speaker, dear Bob. We really appreciate you took the time today to give us this amazing and inspiring talk. Harold, do you want to add something else?
No, let me finish by thanking Professor Merton. It was a wonderful presentation, and I see a lot of comments in the chat of the audience thanking your wonderful speech. So thank you very much for being here, and I hope we will in the future be again together, but directly in our, in our university. So thank you very much.
Well, thank you all. Thank you, the audience, for your coming and your time and for your questions. Thank you for inviting me here from the university, from the department. It's a great pleasure to be with you. And I hope maybe somebody gets stimulated and feels a little excited about all of what's before us. Big challenges, but big opportunities. And that's a lovely world to be in. And I can just say to you, I've been in this now in practice. I got my PhD in 1970. So you can do the arithmetic, okay? And I've had the great good fortune to be a little part of all of this. And it's really, really been exciting and fulfilling. And it's really kind of fun to be doing something where you feel it's intellectually challenging, it's something you love doing, and you can have a sense that what you do might matter in some way. And all I can encourage you is finance is a global area. It permeates everywhere in the world. The principles of finance, like the principles of physics, apply everywhere in the world. So if you've learned them well, you can practice your craft anywhere. So if you're in a place where things are kind of boring, nothing much to do, pack your bag and go to another place, because there's always opportunities to do these things. And to feel that you can contribute at the same time as having fun and making a pretty good living, that's not a bad combination for professional life.
Thank you. I'm glad. Thank you. Thank you very much. Bye. Thank you.
Bye all. Thank you for having me.
Bye.